Well, hello everyone. We have a very exciting chapter today that covers banking and interest rates. Okay? We'll take a look at the different type of financial institutions. We'll look at the different type of services provided by these institutions. We'll focus on how you should go about selecting an institution for you personally and the components that make up interest rates. We'll also look at why there are changes to interest rates and explain how banking services fit into your financial plans. So you ready? Let's go. First, there are different types of financial institutions. What are known as depository institutions. We'll begin there first. So these are institutions that accept deposits from individuals and also provide loans. So think about your commercial banks. Well, there's a Wells Fargo, Bank of America, U.S. Bank, etc. These are examples of what's known as depository institutions. With these institutions, they're going to insure your money up to a maximum of $250,000. So deposits made by individuals and companies are insured by the FDIC, which is the Federal Deposit Insurance Corporation, up to an amount of $250,000. Okay? There are saving institutions. These institutions are ones that accept deposits from, again, companies and individuals. They may also provide things such as mortgages as well as personal loans. And we'll talk about these different type of savings institutions. Then you have your credit unions, which are nonprofit depository institutions, but they also do the same thing. They also accept deposits. They may provide mortgage and loans as well. So we'll talk about these different types of financial institutions. Then you also have what are known as non-depository institutions, meaning that they do not offer federal deposit accounts. So you're not going to make deposits into these type of institutions. However, they do provide a variety of financial services, such as finance companies. We'll look at different type of finance companies that, again, you don't make deposits to these companies, but they provide you with personal loans to individuals. So think about the company you might have went through to get your car finance. Maybe it was GMAC or some other institution where they're not accepting deposits from the clients, but they will provide services such as loaning funds to those individuals. Security firms, which allow you to purchase or sell different type of securities, i.e. maybe Ameritrade, where they're a non-depository institution. However, they facilitate the purchase of or sale of securities such as stocks and bonds. Then you have your insurance companies. Insurance companies are also non-depository institutions that provide insurance to protect individuals or firms against possible adverse events. So what this means is that companies are allowed to have insurance policies to protect their assets. So in case of a loss, uh, they may receive funding from the insurance companies based upon the type of policy that they have with the insurance company. Think about your auto insurance. Why do you have auto insurance? In the case of an accident, you have an insurance company that will help to get your vehicle prepared. And if you hit someone else's vehicle, also repair their car as well. So a company has a different type of insurance policy as well to protect their finances. Then you have these investment companies that sell shares to individuals. So companies such as a Prudential, maybe a Smith Barney, these are investment firms, and they sell shares of stocks of securities to individuals, and then they create what's known as mutual funds. So if you talk to your employer, if your employer has a 401k plan or any type of retirement plan in place, then there's some investment company that's going to oversee those funds. They actually take the uh, information, they take the funds received from those companies, and they invest those funds and create what's known as mutual funds. Now, there are some institutions that we call a financial conglomerate, meaning that they provide a variety of different types of financial services, such as Bank of America and Citigroup are examples of financial conglomerates, meaning that with these companies, they can loan you money. You can make deposits with them. They do mortgages. They sell securities. So here's an example. So again, let's say Bank of America. With Bank of America, they do provide. They have a bank subsidiary where again they do accept deposits from their clients. They provide personal loans. They offer credit cards. Then they have a security subsidiary as well. Can get that out. Subsidiary, and they provide brokerage service such as allowing you to purchase and sell stocks, as well as other types of mutual funds. And then they also have an insurance subsidiary that provides you with insurance services. So when you have a financial conglomerate, it means they're offering a wide variety of financial services. So just some of the services that are offered by these financial institutions. Think about your personal bank. Of course, they provide you with checking services that allow you to draw on funds by writing a check, paying your bills on time. Typically, most banks have online banking now where you can actually make payments to your different creditors by just going to your bank, going online to the bank, setting things up. So you can do things such as, of course, make your car loan payments, things of that nature. Uh, Now, typically, fees are charged by some of these companies for online banking. Others has free online banking. So make sure you're aware of the policies set by your bank when it comes to these different type of services. So as I mentioned again, with a checking account, you're issued a debit card that allows you to use that debit card to draw funds from your checking account. Most banks now have a smartphone app where you can download. For example, Bank of America has a smartphone app where you can download the app and do transactions on your phone. And then, of course, we mentioned online banking where you're allowed to pay bills online, do transfers online, receive deposits online. These are just some of the different functions that are offered by these financial institutions. Now, with the credit card finance, a lot of banks now offer you an actual credit card. So you may have a Bank of America Visa or a Wells Fargo MasterCard. So a lot of these financial institutions offer you have the ability to receive a credit card from them. And of course, you also have a debit card as well, which is tied into your checking account or it can be tied into your savings account. Safe deposit box. When you have certain valuable information, whether we're talking about certain documents, which could be bond certificates, stock certificates, it could be your will, anything that you find of value, jewelry, you can have a safe deposit box where your items are stored at a location inside of a bank vault for your protection. Now, there is a fee you charge for having a safe deposit box, but people like the security of knowing that valuable items are in a safe location inside of a safe deposit box. Of course, we know about ATMs, which allows you to make deposit or withdraw funds at any time of the day. Now, be cautious that typically when you use the ATM of another institution, they are going to charge you a finance charge. So if you're bank with Bank of America, but you go to an ATM owned by U.S. Bank, they will charge you a fee. So typically, if you go to the ATM of the bank where you bank, you would have to pay a fee for using the ATM machine. Okay? Other services provided by these institutions consist of things such as cashier's check and money order. Sometime when you need to make a purchase, let's say in terms of real estate, they're not going to accept a personal check. You can't buy a house and bring in a bunch of cash. So typically they require a cashier's check or a money order. These items are checks written on behalf of a person, but it is guaranteed by that institution so that when you give someone a cashier check or a money order, they know that those funds are going to be good compared to when you're using a personal check, those funds may not be available. Selected a financial institution. So you're saying, well, do I go to the bank? Do I go to the credit union? These are some of the factors you should take a look at when trying to determine how to select a financial institution. First, convenience. How many locations does the institution offer? Are they close to where you live, close to where you work? Do they offer online banking? Can I pay bills online? Are the ATM locations nearby? What type of rates are they offering, on my deposits? What type of fees are they charging? So these are some of the factors you should consider before you choose a institution to deposit your funds into. Now we'll talk about interest rates on deposits and interest rates on loans because these rates impact both your cash inflows as well as your cash outflows. First, we have what's known as a CD, which is called a certificate of deposit. This is an instrument offered by depository institutions and specifies a minimum investment, an interest rate, and a maturity. What we call a CD, it allows you to purchase a CD from, let's say again, Bank of America, and it may say the minimum could be $1,000. It may have a 2% annual interest rate, and it matures in 1 year. That means at the end of that 1 year time, you're going to receive the face value for that CD along with the interest that has accrued on their certificate deposit over a specified time period. It has what's known as a risk-free rate, a return on an investment that is guaranteed for a specific period. So with a CD, if it has a 2% interest rate, that is known as the risk-free rate. You're guaranteed to receive a 2% return off of your investment at the time that investment is going to mature. We're going to come back and talk more about interest rates and other factors that will impact your decision on choosing a financial institution. Stay tuned.